Crafting these videos is no small feat. Be our motivation. Hit that subscribe button and give us a thumbs up to fuel our creative fire.
Commentary on Chapter 2. Americans are getting stronger. 20 years ago, it took 2 people to carry $10 worth of groceries. Today, a 5-year-old can do it. Henny Youngman. Inflation? Who cares about that? After all, the annual rise in the cost of goods and services averaged less than 2.2% between 1997 and 2002, and economists believe that even that rock-bottom rate may be overstated. 1. Think, for instance, of how the prices of computers and home electronics have plummeted, and how the quality of many goods has risen. Meaning that consumers are getting better value for their money. In recent years, the true rate of inflation in the United States has probably run around 1% annually, an increase so infinitesimal that many pundits have proclaimed that inflation is dead. 2. The money illusion. There's another reason investors overlook the importance of inflation, what psychologists call the money illusion. If you receive a 2% raise in a year when inflation runs at 4%, you will almost certainly feel better than you will if you take a 2% pay cut during a year when inflation is 0. Yet both changes in your salary leave you in a virtually identical position, 2% worse off after inflation. So long as the nominal, or absolute, change is positive, we view it as a good thing, even if the real, or after inflation, result is negative. And any change in your own salary is more vivid and specific than the generalized change of prices in the economy as a whole. 3. Likewise, investors were delighted to earn 11% on bank certificates of deposit, CDs, in 1980 and are bitterly disappointed to be earning only around 2% in 2003, even though they were losing money after inflation back then but are keeping up with inflation now. The nominal rate we earn is printed in the bank's ads and posted in its window, where a high number makes us feel good. But inflation eats away at that high number in secret. Instead of taking out ads, inflation just takes away our wealth. That's why inflation is so easy to overlook, and why it's so important to measure your investing success not just by what you make, but by how much you keep after inflation. More basically still, the intelligent investor must always be on guard against whatever is unexpected and underestimated. There are 3 good reasons to believe that inflation is not dead. As recently as 1973 to 1982, the United States went through one of the most painful bursts of inflation in our history. As measured by the Consumer Price Index, prices more than doubled over that period, rising at an annualized rate of nearly 9%. In 1979 alone, inflation raged at 13.3%, paralyzing the economy in what became known as stagflation, and leading many commentators to question whether America could compete in the global market. Place. Goods and services priced at $100 in the beginning of 1973 cost $230 by the end of 1982, shriveling the value of a dollar to less than 45 cents. No one who lived through it would scoff at such destruction of wealth. No one who is prudent can fail to protect against the risk that it might recur. Since 1960, 69% of the world's market-oriented countries have suffered at least one year in which inflation ran at an annualized rate of 25% or more. On average, those inflationary periods destroyed 53% of an investor's purchasing power. We would be crazy not to hope that America is somehow exempt from such a disaster. But we would be even crazier to conclude that it can never happen here. Rising prices allow Uncle Sam to pay off his debts with dollars that have been cheapened by inflation. Completely eradicating inflation runs against the economic self-interest of any government that regularly borrows money. Half a hedge. What, then, can the intelligent investor do to guard against inflation? The standard answer is, buy stocks, but, as common answers so often are, it is not entirely true. Figure 2.1 shows, for each year from 1926 through 2002, the relationship between inflation and stock prices. As you can see, in years when the prices of consumer goods and services fell, as on the left side of the graph, stock returns were terrible, with the market losing up to 43% of its value. 8 When inflation shot above 6%, as in the years on the right end of the graph, stocks also stank. The stock market lost money in 8 of the 14 years in which inflation exceeded 6%, the average return for those 14 years was a measly 2.6%. While mild inflation allows companies to pass the increased costs of their own raw materials on to customers, high inflation wreaks havoc, forcing customers to slash their purchases and depressing activity throughout the economy. The historical evidence is clear. Since the advent of accurate stock market data in 1926, there have been 64 five-year periods, i.e., 1926 to 1930, 1927 to 1931, 1928 to 1932, and so on through 1998 to 2002. In 50 of those 64 five-year periods, or 78% of the time, stocks outpaced inflation. 9 That's impressive, but imperfect. It means that stocks failed to keep up with inflation about 1/5 of the time. How well do stocks hedge against inflation? 2 acronyms to the rescue. Fortunately, you can bolster your defenses against inflation by branching out beyond stocks. Since Graham last wrote, 2 inflation fighters have become widely available to investors. REITs. Real estate investment trusts, or REITs, pronounced REITs, are companies that own and collect rent from commercial and residential properties. 10 Bundled into real estate mutual funds, REITs do a decent job of combating inflation. The best choice is Vanguard REIT Index Fund. Other relatively low-cost choices include Cohen & Steers Realty Shares, Columbia Real Estate Equity Fund, and Fidelity Real Estate Investment Fund. 11 While a REIT fund is unlikely to be a foolproof inflation fighter, in the long run, it should give you some defense against the erosion of purchasing power without hampering your overall returns. Tips. Treasury Inflation Protected Securities, or TIPS, are U.S. government bonds, first issued in 1997, that automatically go up in value when inflation rises. Because the full faith and credit of the United States stand behind them, all Treasury bonds are safe from the risk of default or non-payment of interest. But TIPS also guarantee that the value of your investment won't be eroded by inflation. In one easy package, you insure yourself against financial loss and the loss of purchasing power. 12. There is one catch, however. When the value of your TIPS bond rises as inflation heats up, the Internal Revenue Service regards that increase in value as taxable income, even though it is purely a paper gain, unless you sold the bond at its newly higher price. Why does this make sense to the IRS? The intelligent investor will remember the wise words of financial analyst Mark Schweber: the one question never to ask a bureaucrat is, why? Because of this exasperating tax complication, TIPS are best suited for a tax-deferred retirement account like an IRA, KEO, or 401k, where they will not jack up your taxable income. You can buy TIPS directly from the U.S. government at www.publicdebt.trees.gov/of/ovenflynn.htm. Or in a low-cost mutual fund like Vanguard Inflation Protected Securities or Fidelity Inflation Protected Bond Fund. 13 Either directly or through a fund, TIPS are the ideal substitute for the proportion of your retirement funds you would otherwise keep in cash. Do not trade them. TIPS can be volatile in the short run, so they work best as a permanent, lifelong holding. For most investors, allocating at least 10% of your retirement assets to TIPS is an intelligent way to keep a portion of your money absolutely safe, and entirely beyond the reach of the long, invisible claws of inflation.